Hey guys, welcome back to the channel. So today I'm going to talk about Dbox. If you've been following our videos for the last 2 months, we've been talking about the stock like ad nauseum. Almost every second video has been about the stock, and the numbers came out. They were really good. I was able to talk to the management just because of this channel and because of all the people that have subscribed to the channel. So I really appreciate each one of you who has subscribed. That's the only metric I care about. I don't have anything to sell you. I'll never have anything to sell you. All I really have is the followers, and that's something that means a lot to me because as I said, I want to reach out to more people, and I want to have like more opportunities, and managements come over and talk to us about different opportunities, and so we can ask questions and stuff. So if you can please subscribe, I would really appreciate it. If not, that's okay as well. I'm going to talk about the earnings. I'm going to talk about the future of the company. There was a couple of hires that the company made which are very interesting, and I think I know where this is going at this point, and why I think there's a bunch of monetization opportunities for the stock over the next 6 to 12 months, and why the stock will be significantly higher in my opinion at this point. This was almost 30% of my portfolio. I haven't sold a single share still. I'm even after this move, I'm up like almost as a share, like almost 35%. I sized in at various points at 29-28 cents. Most of my entries were at that point, but still, I mean, I'm just going. We have some really nice data. One of the people who saw the video or like saw my tweets, they reached out. They've put it together, a tracker together to track the theatrical installations, and the data will actually like baffle you. In July, the installations have just gone substantially higher. The Cinemark earnings also came out, and they also said that they were increasing the install base. So that's something that's really interesting to see. I think they're doing this because in Q4, the company's Q3, there's going to be a bunch of really big releases, especially the Avatar, and then also I think the movie with Ariana Grande. I'm blank. I think Wicked is the name of the company, the movie, and then there's a bunch of really good Marvel movies that are releasing next year, which will also be huge for the company. And I think they're just getting ready to for that season. And also it's like the D-Box screens are only less like 8 or 9% of the total screens for Cinemark, and they're just expanding them slowly and gradually. But recently, last 2-3 months, they've just gone on this like really fast pace of installing these screens, which will also lead to a bunch of new royalty stream income for them. The other thing that I was noticing here, I'll share some of my tweets that I've put together. We'll go through the earnings as well. So first of all, I'll just look at the theatrical business as I shared you. So this is the gentleman who has been putting the tracker together. Their username is subset underscore member on X. So you'll see here in May, June, and July. In April, May, and June, which was the Q1 for the company, the installations were around, I think it was around 900 screens. Now, just in July alone, they did almost 600. And then August, just the first week, just for Cinemark alone, was 104. He hasn't updated it yet, but I'm quite certain that this August peak is also going to be quite high. Like this is going to be higher as well. And the theatrical business has a potential to be higher than what they reported this quarter already, which was already quite like significant. So it's like 4 million. There's a possibility that this business comes in at 5.5 million next quarter. And then the simulation and sim racing business also would be, I think would probably see a nice little QOQ growth, because there's a Denver sim arcade, that's F1 arcade, that's being released, and then the Las Vegas one, which is the bigger one, is also opening up in I think October. So most of those installations probably will happen in September, probably dripping into October as well. So that's something to keep an eye on, and I think that's also going to be one of the reasons why the system, the installation base will be very strong. Obviously the margins will be a little lower, as we've talked about. The real reason for driving the margin has been the right for use, the royalties portion of the business. So that's one thing that to keep an eye on, like not to compare the operating margins, as the management has told us multiple times. Don't look at this company quarter on quarter. Look at it as like a trailing 12-month business. And that was one of the reasons why we had said that Q4, like when we made that video, Q4 numbers are going to be bad, because we almost saw that being the writing on the wall, and we also predicted the stock price at that time. So that was kind of nice. And also I would highly recommend you follow me on X, because I share a bunch of ideas. Yesterday we were sharing about Roblox and why that was a short, and some of the puts that I'd shared were up like 40% in 24 hours. So yeah, I do share a lot of ideas on X. My username, I'll just link it in the description, so you can go and follow me there. So this was my tweet today. I just tweeted this, right? I guess I'll just share my tweet initially from the earnings. So what I had said was, I was expecting the royalty to come in close to 4 million, and actually came in exactly at 4 million. So this was a little funny joke here at the bottom. So that was kind of nice to see that I think my model is pretty accurate with this company, and kind of have a good handle on what's going on with this company. And I said that this could be the first quarter where the royalty revenue to total revenue percentage could be above 30%. I came in at 31%, and we saw the operating leverage that this was able to drive. So this is my primary reason for liking the stock so much. So every time, a screen is installed, you have the install base goes up. When the install base goes up, you can have like the US box office do the same number in revenue for that quarter, but now you'll have 10% more screens, 5% more screens, right? And everyone who goes to D-Box once is highly likely to go there again because the experience is so good, right? So there's a possibility of like, so there's that higher occupancy, and then you have a higher install base as well, which both of those things, both of those factors will lead to, a higher revenue, higher bottom line as well. So there was a restructuring cost with the CEO that departed for $850 million. $850,000. If we didn't have the $850,000 in this quarter, the operating margins would have come in at 22%. 22% for a small cap, like that's unreal, right? So this is what I said. I said that the argument here is not just income and top line, it's also quality of earnings. The quality of earnings, as I keep on saying this about this company over and over again, is what kind of revenue are you driving, right? Like what kind of revenue, what composes the revenue. So this is just a learning moment. So the reason why I think this company should have a higher multiple, and that's something that I've been saying, like you'll have earnings expansion as well as multiple expansion. When you have both of those things, that's where you have like the best kind of opportunities, and that's what I look for. That's my model around finding companies where you can have earnings growth as well as a multiple growth. So what does that mean? Let's just break it down real quick. You can skip this portion if you're not interested in this. So basically, what happens with this is, like, you're saying that this business should be worth 5 times profits, 10 times profits, 15 times profits. What determines that? You might say growth in earnings, right? Yes, big part of that, growth in earnings. If you think that you can grow earnings at 20%, some people use PEG ratios. They say, okay, well, it's growing at 20%. The PE trades at 10. It's trading at half times, PEG. So that means there's a 2x opportunity. So you can say, well, yeah. So the growth is there, and the company is undervalued. So if the constant growth remains, there should be just right now a 2x, right? So in this scenario, what's happening is the quality of earnings, the kind of company that is, I'm not going to assign the growth rate for what the PE should be. I'm going to assign the cash flows that the business can generate. So one can say, well, like the PE should be lower because when COVID happened, cinemas closed down. This company is not going to make too much money. That argument is a very strong argument. I take that argument, but still, I mean, it's a royalties business, right? And the how often would you expect the cinemas to completely close down? The thing is, people are just discounting, and that's me as well. Charlie Munger or I think Warren Buffett says that if a good strong management goes into a poor business, it's the poor business's reputation that remains intact, because the management is going to suffer because the business itself is so bad that even a good management can't do anything with that. That's basically Berkshire when they started out with clothing mills and stuff, right? Like they were just not going to do well because that business sucked, and I could see that happening. I totally get that point, but the headwinds that were there in this industry were not only from the pandemic, not only because of OTT platforms, not because of Netflix alone. It was also because of the strike that happened last 2 years, right? And also what's happened is the investment in this industry has gone down significantly. So what's happening is now people are just making really strong movies that have experiences attached to them. And F1 was, the point where you could say, okay, well, like F1, I was having FOMO of watching this movie in D-Box, and I went to a theater after such a long time. After going there, after sitting in D-Box, and maybe I'm biased as well, I want to go there again, and I want to sit in a D-Box seat again. So that's something that's there, right? And we're seeing this. It's not just like my anecdotal, biased argument towards this. Like Cinemark is saying this, right? And like if you go on social media and if you see what people are saying about the company and what people are saying about D-Box seats, you see people are just saying like, that I can't go back anymore. Like even older people, younger people, everybody is just saying, if we go to watch a movie again, like this was a life-changing experience, we're going to go watch again in D-Box, right? And that is the reason why Cinemark is like putting so much money in. The other point comes here from AMC. So when I talked to the management, I had asked them, well, like, is there a possibility of another big chain coming in and wanting to have these seats? And like they basically mentioned that they're trying to make it work for different companies, because they're to some extent capex constrained, so they can't put in the money. Even like $10-15 million is like too much for them for putting these seats. So they're trying to like find different ways of making it make sense for them, which could also mean like selling it a little bit of a loss, like razor blade type model, where you sell it for a loss and then make money on the other side of the royalties, where you can just increase the royalties income. And there's so much white space when it comes to developing countries as well. Like I'm from India originally. I could see this being such a popular thing in India. Like people would really like this. It's just there's a novelty aspect to it. So that's just my my broader thesis, and that's why I think this should be an earnings or multiple expansion, because this is a company which is doing well regardless of how the box office is doing. So Q2 is a perfect, is going to next quarter that's coming up now from July to September is what's going to validate my thesis here. What I'm saying is like the admission revenue you'll see overall for Cinemark will be down significantly, because there's not been many releases in August and September. There's not many highly anticipated movies. So obviously the box office, collections is going to be down here overall, but you'll see that the royalty income QOQ will be down much less as compared to the box office. So like if the box office collections go down by 50%, royalties income is not going to go down by 50%, because when people are going and watching these movies, they want to watch in D-Box. So that's another thing that's really good, right? And the other thing, the reason why also I think that there is a potential for a higher multiple, it's say tomorrow, the company wanted to stop their operations, didn't want to have any other business going on. The only business they had was the royalties business. They just need like 5 or 10 employees, right, just to repair stuff, and that's all that's needed. Like it's not as easy as that. But what I'm trying to say is like this could be a 14-15 million ARR business with minimal expenses, guaranteed cash flows, almost near profit. The entire money that they're making is almost going to be a profit, and that's why I do feel like that's about to get stronger as the install base starts to go up. And the operating margins, as I said in this tweet, would have been 22%, right, if there was no restructuring cost. Like how many small caps can you actually find out where the margins are 22%? And that is mostly driven by the royalties business. I love royalty businesses, and they're just one of the best. You can just sit back and relax. Maybe not in this industry, but they have other segments as well, right? Like the defense opportunity that they have with all the spending that's going on in Europe. On like with the NATO expansion and everything else, right? Like the US basically saying that we're not going to help you out. So Europe is trying to become self-dependent when it comes to its defense spending. So there's a bunch of money that's going into defense as well, right? And they're trying to find trying to work on a couple of contracts in Europe, as far as I understand. I think there's nothing that's been said in public, but we're just going through the LinkedIn, me and Subset member, and we kind of found a couple of things that the company is trying to do. So I think even if they get 1 or 2 contracts of that scale, that could be the entire revenue. And then if they get AMC, or if they get like another chain somewhere else in the world, that could be like multiples, right? So there's so much opportunity in this stock. Companies hyper focused on not doing any investor relation work, just trying to like maximize margins, and we're seeing this. The operating expenses as a percentage of total revenue has gone down from 55% to 41% within 4 quarters. So that's why I love this company so much, and I'm not selling a single share. When I do start selling my shares, I will let you know. But right now, that's not the time for me. I don't want to sell out too early from this stock. And the other thing is, I don't really see any opportunity cost in another position where I can have so much conviction, where I can track in quarter revenues, where all the trends are kind of lining up. Like, so that's the reason why I don't want to like sell out so quickly at this point. So theatrical business, as we saw, like this is a lumpy business. Obviously, as I've said in the past, don't look at it as a quarterly business, because last quarter was like, I think it was $1 million in revenue here. Comps were easier as well this quarter, so they do get harder in Q2 and Q3. But from what we can see, Q2 comps, they will probably beat them again because of the robust expansion that's happening with the Cinemark, especially in July. This huge candle that just got printed, and August probably will have some sort of same kind of follow on through here. So that's something to really look at, and kind of I'm really excited about what's happening with this company. The CFO restructuring cost again will happen in Q2 because they get let go of their CFO. So that's something else that'll probably hit profitability, and the royalties business, as I said, is going to be lower. So the profits are not going to be this much, like almost $3 million normalized, but it's still pretty decent. And then they made a couple of new hirings as well. So how I think this is going to play out for them is they are going to either go into a completely like a royalty company, or I think what's going to happen is they're going to sell out the sim business or like a couple of the segments. because I mean the sim business, they're saying that the floor is there and the growth is probably going to be a little less exponential, obviously, right? Like if you got into 10 million, you can't really double it every year. It's just the opportunity set is low, and then it's not that they sell lower priced like systems. Their systems are best of the best, like freaking $20,000 $30,000 for a system, right? So it's not gonna, there's a very small subset of the consumer who can actually buy their products. But the F1 arcade business should lead to a nice floor on this business, and I think there's a higher probability that they actually end up selling this. So if you look at the math here, you have $15 million in cash potentially by the end of this year, and if you do sell your sim business, let's say even for 20-25 million, you got 40 million, right? What's the market cap right now? Like 75 million, 80 million, right? So like you have almost half of the current market cap in cash, and you have almost no debt. And then you have a business that is generating probably 15, maybe in a couple of years, $20 million in ARR in royalties, high margin revenue, right? And then you have the theatrical business. You also have the defense opportunity, which the company also mentioned that they are excited about that, and that what that could mean for the company as well. So I think there's a huge runway for growth still for this company, and I'm not selling a single share. As I said, the quality of earnings are there, and I don't really see how the stock is not much higher in 6 months time. Hopefully you enjoyed this video, guys. I would highly recommend subscribing. Please do that, and please follow me on X as well. The link is in the description. I'll see you in the next one. Take care. Bye.